Last quarter, one company spent $9.72 of capital for every dollar of revenue it booked. And Michael Burry, the man known to predict the 2008 market crash, has just doubled down on his short position. The market just paid $75 billion for a trade that is spending 9 times more than it's generating. 3 questions, 1 answer each. 1. How a Yandex carve-out took a $40 billion order book in barely 2 years. 2. The number in these accounts that even the bulls can't explain away. And 3, whether $277.68 is an entry price or somebody else's exit liquidity. Get this one wrong, and it's an expensive lesson. Welcome back to Wallstreetholic, where we cut through the market noise and deliver sharp, data-driven insights without the hype, bias, or distractions. Everything here is priced off the 14th of August 2026 close of $277.68 after a 43.7% 3-session move. Research and education only, not personalized financial advice. So let's start with the verdict. And it is not the one a 90% rally usually earns. Nebius Group, Nasdaq ticker NBIS, AI cloud out of Amsterdam. Our verdict: fairly valued with medium confidence. Our fair value, $239 to $292 against a price of $277.68. A range, not a point, because one number pretends to a precision nobody here has. Underneath, $582.3 million of quarterly revenue, up 454%. Fairly valued after a 90% rally sounds dull until you see how those headline numbers are built. Intrinsic value, $241, some 13.2% below the price. Then the ladder, tangible floor, $34, bear $107, base $266, bull $404. And the verdict metric, $246. The probability-weighted expected value, each outcome multiplied by its odds and added up, minus 11.5% from here. A $34 floor beneath a $278 stock is either irrelevant or terrifying, depending on what this business does. The business. Nebius rents dedicated GPU compute to AI labs and enterprises and owns its data centers rather than reselling someone else's. That's 98% of revenue. Founder and chief executive Arkady Volozh built Yandex and listed this on Nasdaq in 2024. Over $40 billion of commitments signed. It buys land, power, and silicon and sells finished compute. So what stops anyone else doing the same? Management's answer is the full stack. First in Europe, running NVIDIA's Blackwell Ultra in production, gold rated ahead of most hyperscalers, inference workloads up 3-fold in a quarter. That's a bid for a moat. The structural thing stopping a rival copying you and cutting price. The moat claimed is training and inference on one platform, and it hasn't yet shown up in the financials. Power is the product, and guidance has been raised 4 times in 12 months, from 1 gigawatt to 5. But watch the words. Contracted means secured on paper. Connected means wired in. Target 800 megawatts to a gigawatt. Active means drawing electricity, around 170 megawatts. The gap between contracted and active is where every dollar of this valuation lives or dies. The book is extraordinary. Microsoft, $17.4 billion. Every tranche delivered on time. Meta, 3 agreements, including one where it buys whatever Nebius can't sell. 4 fresh Q2 deals, each above $1 billion. And pricing is stepping up hard. Short duration capacity clears at $40 to $50 million per megawatt against a $12 million base. Microsoft and Meta alone are roughly $47 billion of it, either the moat or the single point of failure. The print. The 12th of August, revenue $582.3 million against consensus near $570 million. Adjusted EBITDA $236.2 million, a 40.5% margin where the street modelled 27.8%. And every cost line fell as a share of revenue. Overheads went from 65% to 30%. But the GAAP loss widened to $190.4 million and depreciation hit $259.7 million. Depreciation now exceeds the entire adjusted profit. Hold that thought, because it becomes the whole argument. Run rate revenue went from $90 million to $3 billion in 18 months. ARR is the last month of cloud revenue times 12. A snapshot of today's pace, not a forecast, which is why it moves violently. Guidance says $7 to $9 billion by December, $5 billion added in 2 quarters. Management says that capacity lands late this year and bills in 2027, the swing factor in every scenario ahead. Adjusted EBITDA margin, minus 20% 4 quarters ago, plus 41% now. But adjusted EBITDA is profit before depreciation, the largest real cost here, so it tells you the operation works, not that the company makes money. On GAAP, the loss got wider. Both are true at once, and the whole bull-bear fight is about which one you're allowed to ignore. Here's what justifies a premium. $9.1 billion of cash against $8.55 billion of debt. Net cash, pay off every lender tomorrow and money is left over. CoreWeave carries $35.6 billion of debt and paid $640 million of interest in 1 quarter. Nebius paid $119 million. When sentiment turns, the levered operator has no room and the net cash operator has options. Now the number that should stop you. Q2 capital expenditure, $5.66 billion, 9.72 times the quarter's revenue. First half free cash flow, cash left after the bills and the upkeep of the asset base, was minus $3.63 billion. Nebius does not become cash generative by standing still. It only works if revenue keeps compounding. Which makes equity a funding instrument here. 12.7 million shares sold at an average of $223.60, roughly 4.7% of the company at prices well below today's. Convertible notes and warrants on top. Some of the upside from here is structurally owed to future capital providers, not to you. This is where the usual toolkit breaks. No price to earnings ratio, because there are no earnings. No long-run average multiple, because there's barely 2 years of history. No return on capital test, because returns are negative. What's left? 9.7 times exit, 2026 run rate. Anyone quoting you a clean price to earnings ratio on this name is inventing an anchor that does not exist. Which brings us to Michael Burry, who is short and calls this the top of a boom. His argument isn't that AI demand is fake, it's that the accounting flatters. Nebius extended its server's useful life from 4 years to 5. Longer life, less depreciation, better reported numbers. But the counter evidence is real. Older GPU prices rose over 30% in a quarter, and the first capacity auction cleared 15% above the best Blackwell price ever. Rising prices on aging silicon says 5 years is conservative, but a 2026 price tells you nothing about 2029. How big is the prize? Around $700 billion a year of hyperscaler AI capital expenditure. Treat that as a ceiling, never a forecast. Addressable market numbers describe the room, not your share of it. And demand isn't the constraint. Management says it could sell its entire 2027 capacity today. You aren't underwriting a sales forecast, you're underwriting a construction schedule. Against the field, CoreWeave did $2.6 billion of revenue last quarter to Nebius's $582 million. But growth is 454% against 112%, and the debt comparison is decisive. $8.5 billion versus $35.6 billion. Second on scale, first on balance sheet. Exactly the trade-off the market has to price. And it prices it at roughly double. 9.7 times exit 2026 run rate for Nebius, 4.5 for CoreWeave. A 2.2 times premium to defend on growth and leverage alone. The base case assumes it narrows to about 1.4 times by the end of 2027. That single assumption, more than any revenue forecast, produces a $266 base case instead of a $400 one. The backdrop matters more than usual, because here, the cost of capital is the business model. Widening AI credit spreads would hit capital expenditure long before revenue. Nvidia sets allocation, and permitting is politicizing. New York signed a data center moratorium in July. None of that is visible in the Q2 numbers, and all of it is visible in the price. Management next. Voloj has met or beaten every run rate target since relisting and delivered on 4 capacity raises. Then the flags, 46 insider transactions in 6 months, all of them sales, not one open market buy, dual class voting, an order to change. Founders selling into a 200% rally proves little alone. Together, it's why confidence reads medium, not high. The street is all over the place, with published targets spanning roughly $144 to $410. A $266 gap on a $278 stock isn't disagreement about a quarter, it's disagreement about whether the model works. When both camps read identical filings and land $266 apart, position sizing matters more than conviction. 5 ranked risks. Critical, a funding gap on $20 to $25 billion of capital expenditure, 25% likely, cushioned by $9.1 billion of cash. Critical, customer concentration, 20%. High, GPU life proving shorter than 5 years, 30%. High, capacity slipping, 35%. And the likeliest, at 40%, is the multiple simply converging to peers with no bad news. Average daily move is 7.7%, so size for a 50% drawdown that settles nothing. So what is it worth? Start with the discounted cash flow, which asks, what is all that future cash worth today? Think of buying a flat to rent out. You don't pay for this year's rent, you pay for every year's rent added together. Discounted, because money now beats money later, and the further out the promise, the less you'll pay. Run it here and you get $106 a share, minus 62%, free cash flow negative until 2030. When your model lands 62% below the price, the honest move is to publish it anyway and ask why. And it isn't a modeling error. Across the whole plausible grid, discount rates from 11.5% to 15.5%, terminal growth from 2.5% to 4.5%, the most generous corner on the page still only reaches $120. No defensible cash flow model gets within $150 of this price. The market is pricing something else entirely, which is why 4 methods get weighted, not one. Tangible book, $34. The cash flow model, $106 at just 15%. Scenario expected value, $246 at 30%. Peer relative run rate multiples, $266 at 40%, because that is how this asset class actually trades. Blend them, $241. Methods that disagree by a factor of 8 aren't a failure of the analysis. That spread is the analysis. 3 futures. Bear, 30% likely, $12 billion of exit, 2027 run rate at 4.5 times, the premium gone, $107, minus 61%. Base, 50%, $16 billion at 6.5 times, $266, flat. Bull, 20%, $19.5 billion at 7.5 times, $404. Weight them and you get minus 11.5%. Not a sell signal so much as proof that a lower entry flips the arithmetic positive. Look how little separates those paths early. Bull and bear revenue differ by $2.5 billion in 2026 and by $25 billion in 2030. Compounding does the rest. All 3 share the same 2026 because 2026 is effectively already contracted. The fork is 2027 and 2027 is decided by whether steel and silicon land on schedule this December. The bull case in 3 steps. 1. The capacity arrives. 800 megawatts to a gigawatt connected by December. 2. Pricing keeps rising, which it has, with payback down to 1 year and 10 months. 3. Asset-backed debt scales and the dilution stops. Get all 3 and you're at $404. Northland is already at $410. Notice what that case doesn't need. No new customers, no new technology, no re-rating, only delivery. The bear case doesn't need AI demand to disappear. Only one of 4 things to slip. The multiple normalizes on its own, which already happened this year, minus 51% in 5 weeks, or depreciation is answered badly, or funding narrows, or a counterparty blinks. In July, one report that Meta might build its own cloud took 17% off the stock in a day. That path lands at $107, not a crash scenario, just the peer multiple applied to a slower ramp. The chart agrees with the valuation, which doesn't happen often, Price above the 20-day, 50-day, and 200-day averages, relative strength at 64.6. But price sits 35% above its 20-day average, with an unfilled gap from $193 to $216 below. A great trend and a terrible entry are not the same thing. Who is this for? Someone with a 3 to 5 year horizon who can sit through a 50% drawdown without changing the thesis. Not income investors, not anyone needing the money inside 2 years, not anyone sizing above a few percent. Matching a stock to your situation matters more than whether it's good. A very good business attached to a very demanding price. An argument about entry, not the company. Mark the calendar, the 10th of November, Q3 results, a street-tracked date, consensus earnings at minus $1.40, then December for connected power, then February for the first formal 2027 guidance. Dated catalysts matter because they're when the market is forced to reprice and one decides everything. Connected power at year end because revenue, margins, and the multiple all follow gigawatts delivered. Verdict: fairly valued, medium confidence, expected value $246 against a price of $277.68. So the action isn't to chase a 43.7% move. It's to sell the 16th of October, $230 cash secured, put for roughly $21.85. But volatility first. Implied volatility is the market's forecast of how much a stock will swing, about 97% here, against realized volatility of 133%. Implied below, realized means the premium isn't rich. Options can lose money fast and aren't for everyone, which points to one conclusion. Be a seller of that premium here and never a buyer. The mechanics. A cash secure put means setting cash aside and being paid to promise to buy the shares at a fixed price. Here, $230, expiring the 16th of October, roughly $21.85 of credit, 9.5% of the strike over 61 days, and it expires before the 10th of November print, so no earnings gap risk. Assignment gives a basis of $208.15, 22% below fair value, a welcome outcome. Size at 1 to 3% of a portfolio. And that 2028 leap call at 103% volatility, don't buy it. At that price, you're paying for the very uncertainty you should be selling. Every method on one page. $34 tangible book, $107 bear, $241 intrinsic, $266 base, $277.68 the price, $404 bull. That $239 to $292 range is simply the base case plus or minus 10%. And the $34 matters because it means there is no asset floor here. All the value is the forward contract book. 3 horizons: long-term, constructive, a credible top 3 Western neocloud with the sector's best balance sheet. Medium-term, neutral to positive, dependent on delivery. Short-term, cautious. Fundamentals, 8 out of 10. Technicals, 7. And the line worth repeating: the business is excellent, the price is full, so the most valuable thing you can do is get paid to wait. Which leaves one last job, showing you where every one of these numbers came from. Every figure traces back to Nebius's own Q2 filings and live market data, all as of the 14th of August 2026 close. So the thesis: an exceptional operating business with the cleanest balance sheet in its sector, priced for flawless execution. Intrinsic value, $241 against a price of $277.68. Fairly valued, no margin of safety, and a 30% chance of a 61% drawdown that resolves nothing. The disclaimer: properly. This is research and education only, not personalized financial advice. Data is current to the 14th of August 2026, so verify live prices before acting. Options carry real risk, including assignment and total loss of premium. Consider speaking to a licensed professional who knows your situation. And notice what we didn't do today. We didn't bury a cash flow model that came in 62% below the price, and we didn't dress medium confidence up as high. At Wallstreetholic, we ignore the hype and follow the same disciplined, data-driven process. being transparent about what we know, what we don't, and where the evidence leads. If you want to cut through the noise, hit subscribe, give the video a like, and share it with others. This is a subscriber-led channel, so the more requests we receive, the more in-depth research and deep dives we bring to you. See you in the next video.